this presentation, basically I'm covering an overview of project finance and then move on to some of the specifics associated with structuring a project finance transaction. Then second half of the presentation is about public-private partnerships. To start with, the simple question, what exactly is project finance? How is it relevant for Mongolia? Project finance is basically a financing technique which is used for development of discrete assets with its own cash flows. It has been widely used all over the world for the development of capital-intensive projects, and it is definitely relevant for mega projects in Mongolia. From what we see, Oyu Tolgoi or Tawan Tolgoi IPP or CHP5 project in Mongolia are all expected to use project finance to raise financing. These are large projects costing at least $800 to $1 billion. Of course, smaller projects can also be project financed, but it is always useful to have a certain threshold before you consider project financing. Would you do project financing for a $50 million project? Probably not, because it's a bit too small. Upfront cost associated with project finance is relatively higher. You have your development costs, your advisor costs, financing costs. Those take up a significant chunk. So it may not really make economic sense to use project finance for small projects. Probably you may want to look at least $100 million size transactions. So what's the history of project finance? Apparently it was used for seafaring expeditions by the Greeks in the ancient days. And more recently, it was used for the Suez and Panama canals. And historically, it started with financing of the oil assets in the US, then moved on to other infrastructure projects in Europe, and now in Asia it's widely used in power, roads, airports, ports, social infrastructure projects like education institutes, stadiums, prisons, parliament buildings. A wide range of assets can be project finance. So what's the difference between project finance and the typical corporate finance? In a project finance, you are basically looking at a single source of revenue. Hope I'm safe. In project finance, you're basically looking at a single source of revenue for your repayment. Let's take the example of this hotel, Blue Sky Hotel. If it had been project financed, you would be basically looking at the revenue generated by this hotel for the repayment of the loan. Say if I were to give 100 million loan for the development of this Blue Sky Hotel, I'm going to look at the revenues generated by this hotel alone. Its restaurants, the room tariffs, that will be my only source of repayment. I can't go to the shareholder of Blue Sky and tell them, okay, you have another hotel down the road. I want to use that revenue to repay my loan. No, that's not going to work. If I am project financing this Blue Sky Hotel, I can rely only on the money generated by this hotel, nothing else. And because I'm relying only on revenues from this hotel, what I'll do is I'll take security over this hotel. they will have to pledge this hotel to me until my 100 million loan is repaid. So what bankers do is we take security over the asset, security over the shares. If for some reason something goes wrong, the loan is not being repaid, the bankers take over the asset and get the loan repaid. Whereas in the case of typical corporate finance, if I were to finance Blue Sky on a corporate finance basis, if something goes wrong with the operation of this hotel, I can go to the other assets owned by the shareholders and seek repayment for my loan. What are the benefits of project finance? Typically, project finance has been used for infrastructure projects, natural resource projects. These projects tend to require longer tenor debt financing. The longer the tenor of the debt you get, the cheaper will be the power generated by the power plant, or the toll that you have to pay for the road that you're using, or the tariff you have to pay for the port. So project finance enables you to get long tenor financing. 15, 20 years is possible. Whereas in the case of typical corporate finance, it's generally very challenging to go beyond, say, 7 years, depending on which country you are in. Then another important benefit is that project finance allows you to diversify your financing sources. You have access to various sources like commercial banks, multilaterals like ADB, IFC, or export credit agencies that will help you finance projects. And for example, mega projects in Mongolia are being supported by various sources of financing, the multilaterals, commercial banks, and the export credit agencies. And their involvement is very important, because otherwise it becomes very challenging to raise such a large amount of capital. Commercial banks alone may not be able to support, say, a $2 billion project. That is where you need to bring in multiple sources of financing. Project finance enables you to do that. Another key benefit is that when you compare with a typical corporate finance, in project finance you can raise large amount of debt or large portion of your financing in the form of debt. If you are doing a $1 billion project, it is very possible that you can raise out 80% of that, say 800 million, through project finance. If you're doing a $1 billion power project, you could do 70 to 80% of that with project finance, debt financing. Whereas in the case of corporate finance, it is not very easy to raise that level of financing. If you're doing a $1 billion project on a corporate finance basis, you may be able to raise 50 to 60% of that in the form of debt financing. So what are the type of projects that you can do project financing, and what are the characteristics of project financing? In project financing, you are looking at one particular source for your repayment of your loan. So you need to be able to clearly define what the revenue from that asset is. Power plant, it's very clear. Power plant will have a contract with the national utility, which will pay on a regular basis for the power that is being produced. So it's a very clearly defined revenue stream. Or in the case of a mine like Oyu Tolgoi, it's going to sell its copper and gold. You know what the resource available at Oyu Tolgoi is. You know what the copper price is. Of course, the prices can go down, but at least the volume is very well defined, and the market is, everyone has a clear view of what the market looks like. So it's reasonably, one can determine the cash flows reasonably well. So in project finance, there needs to be one needs to be able to clearly define what the revenue stream is. Can you do that with an internet startup? No, you cannot. So that's a clear differentiation. I mean, as a software company, it might be difficult to do project finance, but an asset with very clearly defined cash flows, that is where we do project finance. And one area where project finance is very popular is regulated assets. By regulated assets, you are looking at transmission lines, power projects, water projects, airports. Why it is safer for project finance is that these assets are very clearly controlled by the government, and for these assets, one can clearly define what the future looks like. A transmission line. Are you going to have multiple transmission lines coming up? Probably not. And these assets, these regulated assets, tend to have a very clearly defined cash flow stream. And a key feature of project finance is that it has a very tight contractual structure. If you were to do a financing, you will have documents which are this high. It takes a long time to do that. And the reason why it is like that is because someone is giving you $1 billion based on a single asset, a power plant which has not been constructed yet. So banks are lending $1 billion to something that is not there. So the investors are extra cautious, and they try to ensure that everything is tightly documented, contractually very robust, so that the $1 billion can be repaid over the next 15, 20 years. So that can make it a slightly painful process, but the benefit is that you get 15, 20-year financing, cheap financing, which enables the consumers, say, of a power plant to get very low power tariff. So this slide gives a typical structure of a project finance transaction, or the parties involved in a project finance transaction. Project finance, a project is typically undertaken by a special purpose company, the project right in the center there. You tend to set up a discrete company which will be solely responsible for running the project. Say, for example, if a Mongolian corporate is doing a power project in Mongolia, they may set up a subsidiary which will be solely responsible for doing the project, a special purpose vehicle. Now, this special purpose vehicle will be the one that undertakes the project and gets into the various contracts required to develop, construct, finance, and operate the project over its life. So who are the parties involved in a project? Let's take the example of a power project. Power project, you need a coal supplier. So the project typically signs a contract with the coal supplier. and that coal supply will need to be for a long term. Say, it is not unusual to have, say, contracts of at least 10 years on a rolling basis. That depends on the security of coal supply. If coal is abundant, one may live with a 3-year contract, or which can be rolled over indefinitely. Then you have the off-takers. Who does this power plant sell the power to? So if you are trying to raise 20-year financing, financiers want to ensure that the project has a contract for at least 20 years. Normally it tends to be 25 or 30 years. And that power offtake contract will be with the national utility, which will then distribute the power to the end users. Then there's the construction contractor. In a power project, there are two discrete parts. One is the construction phase and the operating phase. This project SPV is just a shell company which does not have any expertise. It may have project development expertise, but they are not a construction contractor. So they will sign a contract with a company which has expertise in constructing power projects. And it's typically a fixed price contract. Now, and once the project construction is complete, then the project moves to the operator. The operator will operate the project for the next 25 years. So basically the SPV is just a shell which is managing the process. So firstly, it manages the construction through the EPC contractor, and after the construction is complete, it manages the oversees the operation through the operator. Then there are other elements like the sponsors, basically the shareholders, and the financiers. And of course, government has a key role to play because government will set the rules under which these projects are undertaken. And in some countries, or rather in developing markets, government has a bigger role to play because the government may need to provide some guarantees for the offtake. For example, say in the case of the CHP5 project, it is likely that the government may need to guarantee the obligations of the offtaker. Offtaker, the national utility, may not be perceived as financially strong by the bankers, in which case the government may need to stand behind the offtaker and say, okay, if the offtaker defaults, the government will step in. And that's very common. It's being done in other markets, say Indonesia. It had been done in a few other Asian, it is being done in Vietnam. And depending on the stage of development of a country, the government does support financing of projects. And it's a very reasonable thing to do. The national utility is 100% owned by the government, and power is a very important service to be provided to the population. So it is a natural thing for the government to support the development and operation of a power project. The key element of doing project finance is the due diligence and the steps that the banks go through before they finance a project. And we typically call this risk analysis. What we are trying to do here is to learn about the project, understand the project, what the project entails, what is the risk to my cash flow, and how do I mitigate those risks? What happens if my buyer doesn't pay? What happens if my construction is delayed? What happens if my operator is not performing well? It's not rocket science. It's it's simple, basic business analysis. And everyone does this in their business. What do I need to do to secure my investment? Secure the return on my investment. That is what the banks do through this risk analysis process. So what are the risks that are typically involved? To start with, there is the country risk. Banks take a different view on different countries, obviously. Frontier markets have a different risk perception as compared to a developed market like Singapore. In Singapore, you could do a project without a government guarantee. But can you do that in Vietnam, Indonesia, or Mongolia? It may be a bit challenging. And then there's foreign exchange risk. Say I'm investing $1 billion. Am I willing to accept my revenues in the domestic currency, Tugruk? Probably not. What happens if the currency depreciates? I lose my investment. So if I'm investing in dollars, I would want my revenue stream in dollars. So that's how the bankers mitigate that risk. And market risk. Say again, let me take the example of the power project. Is there market risk? If there's a long-term offtake contract, the market risk is mitigated. So I'm signing a 25-year contract with a national utility. So there is no market risk there. So banks typically try and avoid taking market risk because that adds risk to their cash flow. There are markets where there is market risk in the power sector, like Singapore. It has a merchant power market. But markets like Indonesia, Vietnam, there are no merchant markets. Power is sold on a long-term offtake contract basis. I'm not going through each item here, given the shortage of time. I'll probably touch on one more point here: completion risk. Mr. Eng Sai Khan touched on completion risk in his presentation, where it showed that probably about 25 to 50% of the projects were failing because of completion cost overruns and completion delays. So as an investor in a power project, how do I, as a sponsor of a power project, how do I mitigate completion risk? Firstly, I'm going to select a contractor who is very experienced, who has done similar projects before. So I fully give the responsibility of constructing the project, the power project, to that contractor. And I'll make sure that the price is fixed. I'll say the price, I'm going to give you $800 million to build a power project. If he experiences cost overruns, that's not my problem. That's his problem. And he'll have to complete on time. And if he delays, he'll have to pay me penalties. So that is how bankers try and mitigate the construction risk in a project. Now, getting into a bit more detail of each of these risks, we touched on market risk earlier. The risk is demand volatility and price fluctuation. Like in a power project in Mongolia, there may not be demand volatility and price fluctuation because it's going to be an long-term offtake contract at a fixed price. But a project like Oyu Tolgoi selling copper and gold is to, say, China, there is demand fluctuation, and there is going to be price fluctuation. That is the inherent nature of the natural resources sector. Can the banks do it? Yeah, definitely. Provided certain conditions are satisfied. For example, say if the copper price is $3 and the cost of extracting that, say the market price of copper is $3, the cost of extracting that copper from the ground and shipping it to the customer is going to cost you $2.75 per pound. Are we going to be comfortable financing something like that? Probably not, because you just need a drop of 25 cents per pound for you to lose money. So what do you do in that case, in a situation like that? We look at what is the cost of producing copper. How much does it take for that mine? How much does it cost for the mine to take the copper from the ground, refine it, and take it to the end user? If the market price is $3, is it going to cost them $2.75, or is it going to cost them $1? If it's going to cost them $1, yeah, that is an attractive proposition. Banks are more open to looking at something like that. So that is how banks analyze the risk when it comes to projects where there is price volatility or demand risk. Even if the demand were to go down in the market, say if the copper demand goes down, a mine that produces copper at $1 per pound will survive longer than a mine that produces copper at $2 per pound. When the price goes down, the mine that produces at $2 per pound is going to close down when the price goes below 2. And the surviving mines will be the one which has low cost of production. So that is how the banks try and mitigate demand and volatility risk when it comes to natural resource projects. This issue is not there when you're looking at financing a power project like CHP5. Off-taker risk. This is to do with the creditworthiness of the off-taker. Is my buyer strong enough to pay me? Say if I'm selling electricity to the national utility, is the national utility's financials strong enough? If it's not strong enough, I'm not going to be willing to lend money for 15, 20 years. So what do you do in such a case? And in countries like Indonesia and Vietnam, the national utility off-taker is not perceived as financially very strong by some financiers. So to strengthen that risk, what you do is, or rather to mitigate that risk, what you do is you backstop that risk with a government guarantee. Projects in Vietnam and Indonesia, it's not unusual for the off-taker of power to be guaranteed by the government. So if the national utility fails to pay, the government has to step in and pay for the power. It is likely that that would be the case in Mongolia as well, that in the case of the power sector, the government may need to support with a guarantee. Next is feedstock risk, largely applicable to natural resource projects, oil and gas projects, or mining projects. basically looking at, is there copper or coal under the ground? Have enough studies been done to define the ore body that is under the ground, or the oil or gas that is under the ground? Banks spend a lot of time doing due diligence on something like this, because this is something which you cannot see. This is under the ground, and that is where your revenue is coming from. It has to be extracted before you can generate your revenue. Next is construction and completion risk. I think I touched on this a little earlier. Let's skip this one. Technology and operation risk. What we always try and finance is technologies which are tried and tested, where there is a past track record. One doesn't want to take a risk of a $1 billion risk on something which doesn't have a proven track record. Banks are more comfortable with financing technologies which have a proven track record. And then how do you mitigate operating risk? In projects like this, sponsors try and appoint an operator, again, who has a long operating history, who has prior experience in operating power projects or water projects or mining projects. Force majeure risk. Basically, acts of God. What do you do if there's a flood, explosion, earthquakes, which damages your project? These are events for which insurance is available. Projects always take insurance against these natural calamities. In some cases, projects are required to take insurance for terrorism as well. How this insurance protects the financiers is that, firstly, the insurance will cover the rebuilding of the project, and it will also provide a revenue stream for the period when the plant is not operating. So if because of a flood, the plant is not operating for 6 months, during that 6-month period, insurance will make up for your revenue loss, and it is called business interruption insurance. And how do the lenders go about assessing all these risks? Bankers are not technical experts. They know nothing about power plants. They just know how to lend money. So bankers rely on expert consultants to support in the various aspects of due diligence. They use a reserve engineer when it comes to assessing oil reserves, insurance advisor to make sure that proper insurances are in place. The financial model is an important element of project financing. So you have a model auditor who will confirm that the model has been built correctly. Then technical consultant, market consultant, say for say a copper project, market consultant will give you what is the copper demand situation, say in China, which is the immediate market for copper from Mongolia. An environmental advisor, make sure that project is being done in an environmentally friendly manner. Earlier I had mentioned that banks take, when I gave the example of Blue Sky, the banks take security over the asset. This just shows the different types of security the banks take over the project, showing different phases. You have the construction phase and the operating phase. During the construction phase, you take the EPC contract or the construction contract is assigned to you. And during the operation phase, you have the offtake contracts assigned to you, and the accounts are pledged to you. Whatever accounts that the project opens is pledged to the lenders. All the revenue has to go to a particular account. It cannot go anywhere else. The buyer is instructed to deposit money in a particular account, and that account is pledged to the lenders. And that money from that account can be used only in a particular manner, which I'll come to later. Now looking at different sources of financing available for project financing. At the bottom, you have the equity sources, shareholder loans, mezzanine financing, and on top you have the bigger chunk, which contributes anywhere in the range of 60 to 90% of the financing. So you have commercial banks, multilaterals like ADB, IFC, export credit agencies, Korea Exim, JBIC, development institutions. And in some countries, you can use project bonds, and Islamic finance, quite common in the Middle East and in Malaysia, Islamic finance. And who are the key providers? Commercial banks. Among the commercial banks, the three Japanese mega banks are very active financiers in project finance. Then there are the European banks and few Asia Pacific banks. Export credit agencies, they tend to give a big chunk of the financing, and their financing is typically linked to where the equipment is coming from or who the developer of the project is. For example, Japanese export credit agency may not finance a project which is being developed by Korean sponsors and which is using Korean equipment. So Japanese JBIC will require Japanese content in the project. They will require either Japanese equipment or Japanese sponsors developing the project. Then there are the multilaterals and development finance institutions. Sorry, I'm running through a bit fast because I'm a bit conscious of the time. Financial models in project finance tend to be a bit more complex than in other type of transactions, because it is through the financial model that the bankers try and assess the viability of the project and how strong the project is, how strong the project is, conduct risk analysis on the cash flow using the financial model. The model is used by the sponsors to make their investment decision, what kind of returns they get. And whereas for the lenders, the banks focus on what kind of cash buffer is there to repay the debt. If the project has to pay $10 million every year as interest and principal, is the project making at least $12 million a year or $13 million a year? If the project is making only $11 million a year when it has to pay the banks $10 million a year, that is not a project that the banks will be enthusiastic about financing. Banks typically require some kind of buffer when it comes to financing. And this buffer is measured through something called debt service cover ratio. that is basically how much, basically a definition of how much buffer is there in the cash flow to protect my debt. If they have to pay me $10 million, I would like them to earn at least 13 million a year, say in the case of a power project. Or if it's a project like a mining project, I would like a greater buffer in the cash flow because the mining industry is much more volatile. So in a mining project, if they have to pay me $10 million a year, I may ask for a buffer of maybe 8 million. I may want the project to have a free cash flow of 18 million in the case of a mining project. That is how the banks mitigate the fluctuation, say in copper price or coal price. These are various metrics used by the banks to evaluate the strength of the financing structure. There is debt service cover ratio, debt to equity ratio. Debt to equity ratio is basically what is the ratio of debt and equity in the project. And as I mentioned earlier, in the case of project finance, the percentage of debt can go as high as even 90%. So in advanced markets like UK, for PPP projects, debt of even 93% has been raised. This shows a typical cash flow waterfall. I mentioned earlier that all the revenues generated by the project have to go into an account which is secured to the lenders. And how that money is applied is also clearly specified by the lenders. The money first goes out to pay operating costs, any maintenance capital expenditures, and then this is the free cash flow, which is called the cash flow available for debt service. This is the focus of the banks. What is the free cash flow available after all the expenses? This is where I want the buffer. For a power project, I may want a buffer of 20–30%. For a mining project, I may want a buffer of, say, 80%. So this divided by this number is a ratio called debt service cover ratio. That is the buffer. That is the buffer that banks are looking at. Then you have some cash reserve accounts for additional security. Only after that can the shareholders take out dividends. Before that, dividends are not permitted. This is just to ensure that, firstly, the sponsors ensure that the project is in good operating condition, all the costs are paid. Only then the sponsors are allowed to take money out of the project. Be it a power project or be it a mining project like Oyo told God, each project will have its own waterfall. Only when certain conditions are satisfied, the sponsors are allowed to take money out of the project. Now coming to PPP, public-private partnership. PPP scheme is something where project financing is used. PPP has been very popular in European markets, especially in UK, very actively used in Australia, and increasingly being used in Asian markets. This model is used to procure assets which are traditionally procured by the government. And benefits of using this is that the government is able to delay its expenses, its expenditures, and it brings greater efficiency in the services offered. Like, there are three options mentioned here. This is the traditional procurement, say a university or technical education institute, typically directly procured by the government, calling it procurement of assets. What happens is you build a technical education institute, the government builds it, the government has to pay for it immediately. Be it $50 million or $100 million, the government has to pay for the construction of the institute in the first 2 years of construction. But what happens in a PPP? That payment of 100 million is spread over 25, 30 years. It eases the pressure on the government's budget. A $100 million payment is spread over 25, 30 years. Then of course, there's a privatization. You get the private sector to develop the institute. Then the government has no involvement. So if you look at this, in the case of traditional procurement of asset by the government is involved in all aspects of the project, and government bears the risk of constructing the asset and maintaining the asset over 25, 30 years. But in the case of PPP, the budget impact is over a longer period. The risk is shared. Who bears the construction risk? The private sector bears the construction risk. Who bears the maintenance risk? The private sector bears the maintenance risk. Whereas the government is mainly acting as a facilitator. Say in the case of, just to take the example of the institute once again, the government, which is the public here, provides a service running the institute. Whereas the private sector will construct the institute, make sure that it is in operating condition, make sure it has electricity, make sure it is cleaned regularly, whereas the government can just operate the institute, provide the teachers, and run the education programs, and provide education services to the population. And why PPP? I mentioned some of the benefits earlier. Eases pressure on the government, improves the quality of the service. The government is not bearing many of the risks, the construction risk. The government is not bearing the construction risk. The government is not bearing the operating risk. The government only has to provide the service, provide the teachers, and provide the educational courses. A typical structure of a PPP, again, this is similar to the chart which I showed earlier. You have the project company entering into a contract with the government to provide to do a particular project. It can be a stadium, educational institute, parliament house, a prison, hospitals, all kinds of projects, schools. So the project company enters into a contract with the government to provide a particular service, construct and operate a particular project. And in turn, what the project company does is it signs contracts with other entities to do the construction and operation of the facility. Like in the diagram which I showed earlier, construction contract is given to a construction expert, and the operating contract, or in this case we call it a facilities management contract, is given to another expert. Again, the next slide shows the various contracts involved in a PPP project. This is something which I touched on earlier when I discussed about the project financing structure. I'll skip this slide. Now, what does the cash flow profile of a PPP project look like? In the case of a government procurement, government will incur the construction cost upfront. But in the case of a PPP project, this cost is incurred by the private sector over 2-3 years construction period. And what the government pays is this red line. Over 25-30 years, whatever the term of the contract is. This is not constant, it's slightly sloping because it factors in inflation. So what does this red line pay for? It pays for the debt service, principal and interest, because this orange area is financed by debt and equity. And Yellow is the facilities management cost or the operating cost. If it's a institute, cost of cleaning, electricity, security services, maintaining the garden, these are the costs. And the blue one is the return to the shareholders. So the main point here is government is not bearing this cost upfront. This 100 million government is not paying over 2-3 years. It's paying over, say, 25-30 years. So fundamental point being, it eases the pressure on government's balance sheet. A PPP contract has a payment mechanism which mainly defines how the project company is paid over 25-30 years for undertaking a project. So let's say it is a Parliament House developed under the PPP scheme. As long as the Parliament House is in good operating condition, the government has to pay. Say government has to pay, say, $10 million every year. As long as it is in operating condition, say all the lights are working, it is cleaned regularly, the gardens are in good order. So if all those conditions are satisfied, the government pays to the project company, say, $10 million a year. But if they don't clean properly, there is provision for penalty. If one of the minister's rooms in the parliament is not working, it's not in good condition, the door is faulty, the door got jammed out, to give a simple example, you deduct payment. Out of the 10 million, you deduct, say, $500,000 and pay them only 9.5 million. So you have a payment mechanism which incentivizes the private sector to provide good service, to make sure the lights are operating properly, make sure that the building is cleaned regularly. So if it's not done, there will be penalties applied. This just shows how the penalties are applied. Normally the payment comprises two components, the capacity charge and the operating component. This is the 10 million I'm talking about. This goes to pay the debt service and this goes to pay the operator fee. So the entire amount is at risk. If, say, for 1 month, the Parliament House is not accessible, you don't need to pay this 10 million. You just pay them nothing. This is again the concept of risk analysis, which I touched on earlier when we discussed project financing. Won't get into too much detail here. Okay, this is what a typical financing structure could look like in a developed market. What you can see is the project is financed with up to 90% debt. In UK, even 93% debt has been raised for social infrastructure projects, be it hospitals, schools, or other or prisons. The point here is to briefly touch on how does government make a decision on whether to do PPP or not. The fundamental question to be answered is, does it provide value for money? Is it cheaper for the government to do it on their own, or is it cheaper to procure through the PPP scheme? Of course, the benefit of budget impact also need to be considered. So the fundamental question is, does the project provide value for money under the PPP scheme? So what is used in this analysis is something called the public sector comparator, where the light green portion is the NPV of the construction cost and operating cost over a 30-year period. So when you are looking at value for money analysis, you need to look at the cost of constructing and operating as well. It is not just construction. You're going to, if the government is going to construct it, government has to operate it as well, maintain it as well. So you need to look at what is the cost of constructing and operating it over a 30-year period. So that gives the raw PSC. Now, on top of that, there is a value to the risk borne by the government. The government is constructing and operating a facility or maintaining a facility. The government is bearing all the risk associated with it. If something goes wrong with the maintenance, government has to pay out more. If something goes wrong with the construction, government has to pay out more. Government is taking that risk. So that risk needs to be valued. In the case of a PPP, the government is going to make payments over a 25-30-year period, as I mentioned earlier. So you NPV that payment, NPV of the availability payments. So this is the cost of the PPP. If it is lower than the public sector comparator, then there is value for money in doing a PPP. And the important element is valuing this risk. Because this risk has gone here. The risk that the construction cost will increase, there is schedule overrun, or there is increase in operating costs, there are issues with the maintenance of the project. The government is not responsible for any of that. Government is not responsible for the cost of any of that. That goes to the private sector. So it is important to value this risk that the government is transferring to the private sector. If you don't value this risk, then it's pretty clear. It is always easy, it is always beneficial for the government to do it on their own. But this risk is the most important thing. This risk goes to the private sector in the case of a PPP. So that is how this is the analysis one needs to do before deciding whether to do a PPP or not. How long does it take? Actually, I struggled to prepare the slide. I didn't know how long it will take in Mongolia. Say in UK, where PPP is a commodity, they can do it in, say, 18 months, and probably lower. In Mongolia, it may be a little more challenging. It hasn't been done before, so it may take longer. I would think 2.5 years is a reasonable time frame to look at if you are developing a PPP project in Mongolia. I mean, look at CHP5, for example. The bids were out 2-3 years back. It hasn't closed yet, but it's progressing. Thing is, it's not unusual for Mongolia alone. It is quite common in countries like Indonesia and Vietnam or other similar developing markets for big projects to take time. As each country goes through the learning process, the implementation of the projects will become faster as well. I think that's all I have. There's some basic terms used in project finance which I'm not going to go through. I think we have about 8 minutes for questions, unless Tufshin allows more.